But I want to get back to the Fed, Steve Grasso, because the Federal Reserve, and I know it's very difficult for the audience out there that is not doing this every day to keep track of the alphabet soup of acronyms. The Federal Reserve came in today with another $2 trillion program. Did they effectively bail out a big part of the ETF market?
Yeah, I think they did. So the Fed has always frowned down upon buying risky assets or junk bonds. Today, they said they're going to be buying junk bonds. They're going to be buying collateralized mortgage obligations. They're going to be buying CMBSs. They're buying anything that was in danger of failing. So, Brian, on the show, we always talk about the HYG. You just mentioned it. We use that as the risk barometer. The risk barometer jumped today. It told everyone that the market and everything is not going to be allowed to fail. So in 08, 09, it was too big to fail. Now it's no one will be allowed to fail. So I'm not saying we're completely out of the woods, but it's extremely difficult to sell the market in the next 30 days to the next 60 days because nothing is going to fail. Balance sheets don't matter. Earnings don't matter. The Fed will be buying everything. If you're in poor shape, you're being bailed out. If you're in good shape, you're going to be putting up acceptable numbers. Your stock will rally. So it's not really a Pollyannish view. It's just really realistic. Near term, it's impossible to buy anything that will fail. Bankruptcies, no one's thinking about that right now. Will they happen? Maybe. But right now, it's about bailouts and about stocks that are performing, and it's about virus counts, death counts. So I don't want to belittle that.
No, we never would. Guy Adami, the numbers are staggering. When you look at what the Fed has announced already, you multiply that by possible leverage from the Treasury, okay? We could easily get to 10 trillion with a T. Maybe we need it. I have no idea, but I do know this. To Steve's point, we have never seen a Fed that is, this makes the Great Recession and financial crisis look small by comparison.
It's amazing, isn't it? Obviously, a lot of people spoke about it today. I mean, I find it not ironic that on the day or the day after Bernie Sanders gives up his run for presidency, that we've gone basically Bernie Sanders. I mean, we've effectively now privatized wins, we socialized losses, and there's this belief, and maybe rightly so, that the Fed has our back and they'll buy everything. I mean, that in and of itself is extraordinarily problematic. I mean, with that said, I hear what Steve's saying. I think to a certain extent, the four of us on the show tonight have said similar things. I think Tim's probably been the most bullish. I know Steve has been saying this 2790 level is within reach for a while. I've been saying it as well. I know Karen's been absolutely optimistic. And here we are, not ironic that we close at the level that a lot of us have flagged in a long time. You know, in terms of what the market, if you take the Fed out of the equation, if the market on a valuation basis is probably exactly where we were at all-time highs. If you take what probably would have been $160 worth of earnings and said it's probably closer to 130, although I think a lot of people think it's less than that. And something that Scott Minerd has said still resonates in my head. You know, he has brought up that 1,700 level in the S&P a number of times. I'm not saying we're getting there, and maybe he looks back and says, now with the Fed in the game, there's no way we get there. But, I mean, it's something that still sort of sticks in the back of my mind. So, you know, look, here we are. I think the market is on better footing, but for probably the wrong reasons.
And Tim, listen, you know it. We're all active on social media for some reason. Anyway, all the people are coming out saying, oh, all the negative people on CNBC have been wrong, and look at the market soaring, and they must be fools. Here's the market could keep going up. I have no idea because the Fed programs could do it, Tim, but I'm sure you will agree with this, I hope, and if you don't, let me know, that we've got to be very careful here. A couple days where the market bounces in a terrible market does not mean the all-clear signal has sounded, does it?
No, but fundamentals are not really playing to the fore here. And so, look, my view is that the pain trade has been higher and could go higher. And today, the Fed ripped the face off of shorts, a surprise pledge to buy downgraded corporate debt into the high yield market. I mean, absolutely just completely threw this market upside down. So, we talk about too big to fail, and this is where I get a little bit more, negative and pessimistic, like some of my colleagues here. I mean, I think society fails when you ultimately get into the dynamic that we're painting here. I think fiat currencies may be, an endangered species at some point with this kind of activity. Having said that, again, healing in markets. What do you want to look for? Well, how about the Aussie dollar that's up 14% in 15 days? That's a measure of China. It's a measure of reflation. It's a measure of commodities. How about Treasury volatility, which is essentially flatlined over the last 3 or 4 days, certainly relative to where it was? How about the Japanese yen, which is also, again, a funding currency in this risk-on trade, which is basically back to 6-month levels. Again, when the yen was rallying and looked like we were going to go to 80 dollar yen, it was time to run for the hills. We're back to where we needed to go. So I'm looking at the retail market. If you look at the XRT ETF, which is at least measuring the retail sector, it's outperformed the S&P by 11% over the last 4 days. The parts of the market, and again, they're obviously extensions of the parts of the economy that we needed to see recover more, were the most offsides are the ones that obviously have outperformed here.
When I saw, Karen, the moves today, I instantly thought about you. You know why? Because I know that you've said that you have been short a lot of high yield, but long the banks. Well, today I thought maybe Karen loves and hates this because high yield surged because the Fed basically bailed it out, but the banks also rose today. JP Morgan up, 8%? How did you read it?
I mean, I read it. I don't know what to make, but love it and hate it. A lot of agita, and net, not that much change in the P&L. But I thought the Fed actions were just absolutely extraordinary today. They had to be. We're in extraordinary times. But it, to me, is sort of reminiscent of 2008 when we saw some other extraordinary actions. And I want to just talk about one of them that was the most interesting to me. In September, at the absolute, Lehman had just failed and things were really coming undead. The SEC actually said you are no longer allowed to short financials, which was an extraordinary measure. And I think we have a chart that shows where the BKX index was right around September. And what happened in the 2 days following that, the BKX index was up 28% in 2 days, which is absolutely extraordinary, kind of the kind of reaction we're getting now. But then, as time went on and it became clear that those kinds of short-term policies weren't going to be enough, if we step back and look a few months later, the BKX actually traded down by almost 75%. So I'm not saying that's what's going to happen right now in the HYG, but I am saying this is an extraordinary move by the Fed. I don't think it necessarily means that they're giving you an at-the-money put. I do believe there's a put there somewhere, but I don't believe it's at the money. And a lot of this money that they talked about today is going to debt that is newly rated junk, that was investment grade before March 22nd and now will not be investment grade due to what's happened. That's where the focus is going to be. So it's obvious those kinds of securities traded really well. It's important to note, this is huge for the insurance companies. They are the largest holders of some of these. This is huge for them that there's a buyer of last resort here. But one other thing, to a point that you have followed closely, which is the NAV versus the price of the HYG and some others. The Fed has said, even though they are going to buy ETFs, they are going to avoid buying ETFs that are trading at a premium to, they don't say how big of a premium, but at a premium to the NAV. So that premium really spiked in the last couple of days. I don't know if that means the Fed would no longer buy them right here. I'm not really sure. But the measure is huge. I just sort of think that this will not mean that companies can't fail. I have to say I don't agree with Steve that companies can't go bankrupt. I believe they can. I don't know that the Fed could save everyone, but I do applaud them taking extraordinary measures because we are in extraordinary times.
It certainly is. And some of these close-in funds that we've been talking about, the DSL, Double Line, PCI of PIMCO, DHY of Credit Suisse, they all went up today.